People love to repeat the expression, don't try to catch a falling knife when they're talking about investing in a weakening market or a weakening economy. And like we do every week, Denny, let's question that conventional wisdom. Let's put a pin in that. So
Is that the same as don't time the market?
yes, well, yes, it is. At the end of the day, that is ultimately what we're saying here is don't try to time the market. You can't do it. Every time that I have tried to get cute or clever in my life with trying to time the market or trying to pick the next hot geographical market for real estate or the next hot asset class for investing, the universe has just shoved a big old slice of humble pie down my throat. So don't do it. The best economists in the world can't predict with perfect accuracy when a stock market or a real estate market is going to turn. They can't do it. And if they can't do it, and they have the best data in the world and the best education in the world, you can't do it. It is the height of hubris to think that you can do it. All right, I'm off my high horse. Let's dig into some tangible some tangible reasons why it does make sense to invest even through a weakening economy, which by all accounts we do have. At the time that we're recording this, just earlier this week, there was a revision for job data from March 2025 March 2024 through March 2025. They revised downward the number of jobs that the U.S. economy added by almost 1 million jobs. It was 911,000 jobs. That's a crazy number. So anyway, the point is, by all accounts, we do have a weakening economy in the U.S. Everybody expects that there will be a rate cut in a few days from now in September. By the time this episode is released, we will have had that almost certain rate cut. But yeah, everybody agrees the U.S. economy is weakening, and that's okay. Denny, are you continuing to invest?
Yes.
I am too.
I mean, I have through ups and downs, I've always had real estate, and I've been pretty stable because of it, I think.
Absolutely. So
Not to say I haven't made mistakes. Sorry.
Oh, well, of course.
I have made
Yeah,
mistakes.
but that's okay. And that's part of the point of dollar cost averaging, which we'll talk about, in a few minutes. But, continuing to invest month in, month out, regardless of what the headlines are saying and what the economy or the stock market or the real estate market is doing, over time, the law of averages is going to protect you. So, and we'll dig into some more stats about that. But let's start with one stat here that a huge percentage of the gains that happen in a bull stock market, they happen at the very beginning. So what happens, you'll have this very steep stock market crash typically, and then it'll hit bottom, and no one knows when that bottom will be, right? I mean, we just talked about that. You can't time the market. At around the time of the bottom, you will see nothing but negativity in the headlines. It's all doom and gloom, and the sky is falling, and you should run for the hills.
Which makes things worse, I think. Definitely.
Absolutely. So, it scares the hell out of retail investors. But for people who have that stomach to keep investing through that, there's this bounce at the bottom. And on average, in the first month of a bull market, the first month after a stock market hits bottom and starts recovering, there's a 13.6% average gain in just a month. 13.6
Wow.
average gain in 1 month at the beginning of a new bull market after a bear market. And if we're going to define those terms for anyone who's curious about the technical definition of a bear market is a drop of 20% from a recent high in the stock market. So a new bull market is when that turns around and starts gaining again. So 13.6% in 1 month, the first month of a new bull market. You don't want to miss out on that bounce. But if you are sitting there on the sidelines chewing on your fingernails, you will miss out on that, because by the time it becomes obvious that a new bull market has started, you're months into it. And that those huge gains in the beginning have already passed you by. So keep investing through thick and thin. That's.
And I think investing with fear is not going to work. You have to understand there's ups and downs and all around, and kind of just relax a little bit with it. I know that's
and if
easier said than done.
Right, and if you're not comfortable with that, then guess what? go buy treasury bonds at 4% interest, or
Exactly.
3% or whatever, and barely beat inflation. And guess what? You are not going to build wealth over time.
No.
You will barely beat inflation. And so, yeah, you might not lose any money, technically speaking, but the opportunity cost is just enormous. So, strengthen up your stomach here and keep investing. Um, here's another good reason to keep investing through a weakening economy is that you get discounted prices on your investments. That goes for stocks, it goes for real estate investments. As the economy weakens, and we haven't seen that yet in the stock market. Stock market just hit a record high yesterday at the time that we are recording this. So we're not seeing that yet, but that does typically happen. As the economy weakens, you see stock prices go down, you see real estate prices go down. We have seen that in a lot of real estate markets over the last year. Some real estate markets around the country have flatlined, some have declined significantly. Others are growing, but at a very muted pace. So, yeah, in a weakening economy, you can score great bargains. And one of the reasons that you can score great bargains is that there's less competition among other buyers and investors. And we see that a lot in real estate in particular, where, as the economy weakens, fewer people are out there buying homes, fewer investors are out there snapping up properties. Some investors pull back entirely, others slow their pace of buying. Again, you have this cliche of,
No more
don't.
bidding wars.
Right. Exactly. Exactly. You don't have the bidding wars. So you can go out there and make lowball offers, and some desperate sellers, some very motivated sellers will take you up on that. So it's a good time to, you can find those motivated sellers by making those lowball offers. And of course, you can find motivated sellers in other ways too. You can send mailers to people in foreclosure, for example, or people in tax sale, et cetera. So you can go out and find better bargains on investments, on stocks, on real estate in a weakening economy, because there are going to be some sellers who need to sell and
Right.
who are going to be willing to take a discounted price in order to get out quickly. We saw that a lot in the Great Recession. There was a foreclosure wave, and a lot of people scored incredible bargains when they had the money and the stomach to keep buying, through the Great Recession. And speaking of the Great Recession, just to tie back to something we just said a moment ago, um, the bottom of the stock market in the Great Recession actually happened pretty early on in the Great Recession. It happened in spring 2009. So,
Wow.
Denny, you and I both lived through that as real estate investors, and the Great Recession, went on for years, and it felt pretty gloomy. But the bottom of the stock market was actually pretty early. I mean, it was like 6 months after the Great Recession really started. So, again,
Answer me this, is the stock market, I know we've seen the stock market go really crazy up while real estate is going the opposite direction and the other way around. True?
yeah. So real estate, it got it got pretty frothy. Housing markets in the U.S. after the pandemic got a little frothy, and home prices went up too far, too fast beyond fundamentals. And then when you had interest rates go up in 2022 at a pretty steep pace, that obviously damages affordability, right? It means that the same home price costs way more on a monthly basis. So there's
Oh my
been this
goodness.
affordability pinch in the US over the last couple years, which is only now starting to resolve itself. And we will likely see rates go down, not just the federal funds rate, which the Federal Reserve controls, but also real life mortgage rates, which are not, well, I'll keep this rant very short, but I wrote this whole article for Bigger Pockets, and we sent out a newsletter on this topic about how the Federal Reserve does not control mortgage rates. It controls the federal funds rate, which is the short-term rate that banks lend each other money at overnight.
Yet
So
most people think the other.
Right. And now, yes, there is a strong historical correlation, but over the last year, we've actually seen mortgage rates go up even as the federal funds rate went down. So,
Mm.
Denny, if you remember, last fall, the Federal Reserve cut the federal funds rate by 75 basis points. At the same time, mortgage rates went up. So they're not in lockstep. So mortgage rates are more based on treasury bonds. Um, but anyway, we're going to see interest rates and mortgage rates almost certainly go down over the next year, which will make homes more affordable, both for home buyers and for investors. That will also increase commercial real estate values because commercial real estate is priced based on cap rates, and cap rates move in virtual lockstep with interest rates. So anyway, the
So
point.
with all that being said, what would help? What investments would be recession proof?
Well, so that is a great question. Let me pause that for 10 seconds to just tie in or wrap up that one point that we were just talking about with interest rates.
Okay.
So, in a weakening economy, what does the Federal Reserve do? They cut interest rates, right? Like that's their first go-to move, and they can do other things too. Quantitative easing, where they go out and they buy up a whole bunch of bonds and and flood the economy with money. But the first thing that they ever do in a weakening economy is they cut interest rates, and we're in the process of seeing that right this moment. So lower interest rates makes real estate more affordable for investors. It makes cash flow easier for investors. Bumps up values of commercial real estate, like you and I largely invest in every month in the co-investing club. We're looking at apartment buildings and going in on these big investments together. Anyway, the point is, this is another reason to invest in a weakening economy because you're going to see a lot of economic stimulus from the federal government that makes all of this easier. So if you can go out and you can find great bargains on real estate and you can pay for them with cheaper loans, then this is all great for cash flow, for scoring great bargains, all that good stuff. All right. You asked about recession resilient real estate investments. And this is something that you and I talk about a lot in the co-investing club. For anyone who's not familiar with Denny and me and what we do, we organize an investment club where we meet every month. We go in on real estate investments together, passive real estate investments. And we vet them together as a club so we can all poke holes in these investments from 50 different angles. And this has been a theme that you and I have been talking about for the last year, is really prioritizing recession resilient investments. And fortunately, there's a bunch of them out there in real estate. So, one that people talk about all the time, and I think there is a lot of truth in this, although it can be a little overstated. Class B multifamily can be recession resilient because in a good economy, Class C renters will move up to Class B apartment buildings. In a bad economy or a weakening economy, a lot of Class A renters will move down to Class B. And that's actually a good thing for Class B operators to have those higher caliber renters in place, right? Who potentially have a larger net worth and higher incomes and a deeper cash cushion and can better withstand economic turmoil. So Class B multifamily, I think there is some truth in that. It can be a little overstated, by people who are trying to sell those investments, right?
Class B.
So, one of the investments that you and I, Denny, have featured a lot of this year, and that, I can't speak for you, but that I quite like, are these tax abatement deals, property tax abatement investments, where, the operator will go out, they will buy a multifamily property, they'll buy an apartment complex, and then they will partner with the city or the local municipality on setting aside some or all of those units for affordable housing. Maybe with some rent restrictions in place, usually based on
Right.
area median incomes. And that is great for a couple of reasons. One is that you instantly bump up the NOI, the net operating income for that property. You bump up the cash flow right away without having to swing a single hammer in renovations, right? So you don't have any of that construction risk from trying to add value through renovations. You add value through bumping up the cash flow by cutting the expenses, by cutting out the property tax bill or dramatically reducing it. And people who are not familiar with these deals, their first objection is, oh, well, aren't you also giving up income? Aren't you also giving up rent? And the answer is that if the operator is buying these right, then no, they're not. And for a lot of cases, the market rent is around what that limit would be anyway. The limit for what they can charge, the percent of area median income. So, we've done some of these deals in the co-investing club this year where there was little or no restriction to what the market rent would be for these units, but they have this huge property tax savings. So immediately you're bumping up the value of the property, you're bumping up the cash flow without having to cut rents. or if you do have to cut them, it's marginal. Um, and to tie this back to recession resilience, these units that have caps on the rent and are designated for affordable housing, these become even more coveted in a recession, right? These become even more appealing to renters in a recession. So we love
So
those
it's
deals,
almost a win-win. You up your occupancy and yeah, and you
right?
reduce your expenses. So it's a yeah.
Absolutely. And those units are not going to see a drop in occupancy, even in a recession, at least in theory, right? I mean, this is all theory, or there's obviously good historical data to back this up, but
Right.
you know, what do they say? Past performance does not indicate future results. Uh, all right, a couple other recession resilient real estate investments. While we're on this train, mobile home parks are the ultimate affordable housing, and these can be even more recession resilient if you invest in parks that have tenant owned homes. And the reason for that is that it costs thousands of dollars to move a mobile home, compared to lot rent, which is a few $100s, right? So if you are a renter who owns your mobile home and you're renting a lot in a mobile home park and you get pinched in a recession, uh, you know, maybe your hours get reduced at your job or whatever it is. Uh, it's a pretty simple calculation, right? Do I pay my lot rent? Do I continue paying a few $100s a month for my lot rent? Or do I pay $6,000 to move my mobile home? Right? That's a really easy calculation. So those are in some ways the ultimate recession resilient real estate investment. We've
Not to
also
mention, where are you going to put your mobile home in a flesh?
Well, that too, exactly. So a couple other recession resilient real estate investments we've made over the last year in the co-investing club. We invested in a Section 8 overhang deal, and that is a very niche strategy that most people are not familiar with. Um, it's where an operator will buy an apartment complex with a LIHTC tax credit, the low income housing tax credit. So they're getting this great tax credit, but LIHTC restricts the amount of rent that renters can pay out of their own pocket. Again, based on area median incomes. Um, so what this niche strategy that a few very clever operators have discovered is that if they replace the cash tenants with Section 8 tenants, or they help their existing tenants get Section 8 vouchers, then the government is paying the bulk of that rent, and the portion that the renter is paying, that still that falls within the limits that are set by LIHTC. So they can charge full market rents. Most of those rents get paid by the government, so they're guaranteed rents, and they still get to enjoy the tax credit. So they get to have
That's
their cake and eat
crazy.
it too, right? Very clever strategy. Uh,
Yes.
one final one that we'll throw in, and there's a bunch of these, but we don't want to spend all day on these. Industrial real estate with very stable renters is huge. We did one of these earlier this year that has been a home run. Um,
Yes.
it was a an industrial seller leaseback deal where the seller of the property was also the business. And what they were doing was spinning off the real estate holdings in order to raise some money to expand their business, to grow
Yep.
their business. And it was an incredibly stable company. They did commercial weldments, and their largest client is the U.S. Navy, right? I mean, the U.S. Navy is not going anywhere. Um, and their order backlog was through 2028. So very stable company. Um, and the operator ran the numbers to make sure that even if some crazy event happened and this industrial tenant did stop paying, they could evict them and put a different industrial tenant in there and who would be paying even higher market rents. So yeah, just a couple examples of recession resilient real estate investments. Uh,
And there
here's
are others too, and it's nice that we have those kind of choices. That's
Absolutely, and that's one of the nice things about going in on these investments with other people is that if you go out and try to buy a mobile home park, for example, by yourself, you're gonna probably need several $1,000,000, right? If you're an active investor going out and trying to buy that by yourself. We're not doing that, right? I mean, we as an investment club, first of all, we're pooling our money together.
Right.
So, each person can invest a very small amount. In our case, $5,000 per member is what people can invest. Collectively, we'll be investing in the $400,000 to $800,000 range each month. But we'll still just, even in some cases, we'll just be a small investor in a much larger pool of investors, um, who are funding this larger project. I mean, we've invested in $160 million apartment complexes before. And we were just one limited partner and a whole bunch of investors, and that's the power of investing alongside other people in these, is you can
And it
invest,
lessens the risk.
and it lessens the risk, and it allows you to dollar cost average, right? To keep investing small amounts every single month. This is my own personal real estate investing strategy. Every month I put my own money in all these deals as just one more member of the co-investing club. This is my personal path to financial independence, is investing in real estate every month through this. And I also invest in stocks. I've got a robo advisor that just pulls money out of my checking account every month, or every week rather. And again, dollar cost averaging. I ignore the headlines. I'm not worried about whether it's a shrinking or a growing economy. I keep investing no matter what, and that gives me that exposure, through up cycles, down cycles, and helps me capture those opportunities, even when everybody else, when there's blood in the street, as they say, and everybody else is fearful. This is why we practice dollar cost averaging. Um,
Now, out of curiosity, you say you ignore the headlines, and I know that's not totally true. Um,
well, we want to pay attention to trends in real estate, of course, but that's not the same as letting the market cycle, or the headlines dictate
okay.
whether we're investing or not. Now, it
Right.
might
Becoming
steer us.
anxious and deciding what you're going to invest in and whatnot. Okay.
Right. We're not letting the headlines scare us away from making investments. Now, it doesn't mean that we have our heads in the sand. We still want to pay attention to, what's going on in this asset class. And, maybe there's an oversupply in that asset class and in that city, right? So maybe we don't want to invest in that asset class in that city right now. And that's just informed investing. But we are not letting scary headlines scare us out of continuing to invest month in and month out.
Right.
So informed investing rather than panicking and panic selling, right? Or stopping to invest entirely because you're panicking, because all the headlines are doom and gloom. And one final point here to make, one final very tangible reason to continue investing, at least in real estate, through weakening economies, is that in a weakening economy, people stop building, right? Like, real estate developers stop building
Mhm.
new supply. So that means that, for the next few years after that, because there is a long pipeline for these good development projects, but that means that you're going to have constrained supply for years to come, when all the developers pull back from building permits and they stop building, or they dramatically slow down their building. So, we actually saw that all through the 2010s, and continuing to this day, depending on which numbers you look at, we're between 1.5 and 5 million housing units short of what we need in the U.S. And that's a hangover from the Great Recession, when builders pulled back so much that, for years they just built at a trickle, and that led to this lingering housing supply shortage in the U.S. And over the last couple years, in some markets, that has abated. We look at some markets in Texas, for example, where there is an oversupply of housing for now. Builders already pulled back on that, starting like 6 months or a year ago. Uh, but by and
And I think
large,
it's important to know that location has a lot to do with all of this. Because we're talking about generalizations,
of course, yeah.
but overall, right.
Yeah, absolutely. So, anyway, that's one final reason to continue investing even through a down, or a shrinking economy or a weakening economy, is that there's going to be less new building supply added, which is going to create a great environment for holding for cash flow in the next few years, because it takes a long time for that to work its way through the system, and for new supply to come online again when builders start up again. So, Denny, any final thoughts that you want to make about why people should continue investing even through a weakening economy?
I just, yeah. What do you, like you said, if we stick our money in a bond and it's just kind of slowly trickling, it's not doing anything. And, um,
Or worse,
you
cash,
know,
losing money to inflation.
yeah, exactly. And I think, uh, not to push the club, but I think because there's lower amounts needed to invest, there's less risk of loss. And to me, it's way better to do that than just let your money sit somewhere and do nothing,
Oh yeah,
you know?
and one to illustrate that point, one of the things that you and I talk about all the time is how when the more investments that you make, so in this case, real estate investments, over the course of a year or two or three or five or whatever, those investment returns start to form a bell curve, right? And there's inevitably going to be some investments that underperform, some are going to overperform, most will be in the middle of that bell curve. But if you only invest in one or two investments, then those singular dots could be anywhere on that bell curve. And
Mhm.
you could be investing $100,000, which is the minimum investment in a lot of the stuff that you and I invest in as a club. Maybe that loses money, right? And I would much rather lose money on a $5,000 investment than an $100,000 investment, right? And
Exactly,
I want my
exactly.
investment returns to form that bell curve over time, and that's why we invest 5 grand a month every month, month in, month out, dollar cost averaging. On that note, if you guys got a fresh perspective from this episode, subscribe, pass along the episode to your friends, colleagues, neighbors, family members twice removed. And if you are not familiar with how passive real estate investments work, we do have a free course on that. Sparkrental.com/free. We walk through syndications and private notes and different types of funds and private partnerships and all that good stuff. So, on that note, stay weird, unconventional investor, and we'll catch you next time.